Good morning, everyone. Thanks for waking up early, very early. My name is Raul Munoz. I'm the industry leader for mining and natural resources, and on behalf of everyone at Marsh, we'd like to welcome all of you. Again, thanks for waking up early for a delicious breakfast. We have a full agenda today, but let me start with a few housekeeping items. In the event of an emergency, the exit doors are out to the left, and the muster point is right across the hotel by the lobby. Bathrooms, as you may have seen, are all the way out past the elevators to the left. I'd like to start by acknowledging that we sit on the traditional land of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples. Let me introduce our moderator this morning, Mr. Mike Lewis. He is our head of Industries, Specialty, and Growth. He joined Marsh in 2018 after spending many years in Hong Kong and Australia. Mike, take it away.
Thanks, Raul. And I always like to test the AV people by getting mics very near to each other, just to see if we get some screaming. Welcome everyone to this year's Marsh event at the PDAC conference. And I'm glad that you all found the change in hotels from the Ritz, is where we normally have it, to the Shangri-La, and hopefully with a bit more sunlight and some engaging comments from the speakers, we'll manage to keep you awake throughout the session. So I'm joined by 5 panelists today. So David Lang, who's immediately to my right, who's the chairman of Fortuna Silver Mines. David has more than 35 years of experience in mining operations, projects, engineering studies, mining finance, and corporate development. He joined Fortuna Silver Mines board in 2016 after previously having served as Chief Operating Officer at Economies Gold, True Gold Mining, and Quintana Resources Capital. Welcome, David. Next, Ian Tobin, Economic and Political Intelligence Centre, Export Development Canada. Ian has over a decade of country's risk experience and currently manages the country risk team at EDC. His team of analysts assess economic and political risks facing Canadian exporters. Welcome, Ian. David Rhodes, Managing Director of Endeavour Financial. David has over 30 years of experience in the finance industry, which he has arranged over $10 billion in funding for mining companies, with extensive experience in the Americas, Europe, and Africa. Welcome, David. Paul Mitchell, who is the Global Mining and Metals Leader for Ernst & Young. Paul leads a team of 7,000 mining and metals professionals across all service lines and has 20 years of experience providing consulting services to mining and metals clients around the globe. Welcome, Paul. And our last but not least, our very own Chantal Brazeau, Managing Director and Head of Credit, Political and Security Risk at Marsh. After having 20 years with the Export Development of Canada, Chantal made the right choice to join Marsh in 2021. In her role, she is responsible for advising, structuring and delivering innovative credit and political risk solutions to corporate clients and financial institutions. Welcome, Chantal. So, what are we here to talk about today? Geopolitical risk, geopolitical uncertainty is one of the top risks facing organisations, as evidenced by the World Economic Forum's Global Risk Report that was released a couple of months ago. The report quite aptly states that we're entering a stage of polycrisis, which is a new word that I think a lot of people had to sort of go to the dictionary to find out what that meant, as did I. But what it describes is a number of cascading risks that overlap at the very same time within history. We've seen a lot of the return of bygone risks such as inflation, cost of living crisis, trade wars, capital outflows from emerging markets, state intervention and protectionism, and the spectre of nuclear warfare, all of which few of this generation policy or public policy makers have ever had to experience with respect to their working lives. In addition, specific to this sector, the continual transition to renewable energies is driving sustained growth and need for raw materials and the supply constraints for certain metals are boosting prices and prompting a push for new mining development, investment and exploration. While the aforementioned risks are affecting the entire globe, they're certainly affecting more acutely the emerging markets, as evidenced by the recent upheaval and constant instability in Brazil, Chile, Peru and Mexico. Many of the aforementioned risks are affecting what you're doing in terms of investment decisions and your current operating policies. The resource sector, you are all too familiar with these risks. You have historically been exposed to political pressures and instability, especially given that resource projects that are often pursued are often in local or often in smaller and less stable markets. In the last 2 decades alone, we've seen a series of high-profile political events tied to emerging market natural resources, from forced abandonments of sites in the Solomon Islands to the renegotiations of concessions in Bolivia, Venezuela, the DRC and Zambia, and Argentina's introduction of export taxes and foreign export controls. These are all too familiar to every single person sitting in this room. So today's discussion is meant to provide an overview of key economic and political risk factors that are currently defining the operating environment to which you're all operating, and also the investment in foreign market jurisdictions. While we discuss strategies today for mining companies that are looking to employ strategies to mitigate those risks, we are also looking at providing some solutions that you might be able to present or apply internally. So today's format is simple. I'm going to ask this panel a series of questions to 1, level set and understand the global landscape. 2, explore challenges and opportunities facing miners today. And 3, discuss how you should confront these, the geopolitical uncertainty which will prevail over the foreseeable future. Now, I'm going to be asking a whole bunch of questions, but I'm really looking to you to ask questions throughout this as well. So if you do have questions, we do have some roving mics, and we will be turning to you for questions. So with that, I'm going to start with the panel. So Ian, perhaps the best place and the most appropriate place is to start with you. Can you provide us with an overview of the global geopolitical considerations that underpin the current heightened risk environment?
Sure. Can everyone hear me? Mic's working. So I know we're starting with a light topic this morning, geopolitical risk. It does feel like the world is, riskier, and I don't think it's going to surprise anyone that when we think about geopolitical risk today, we are talking about competition between the U.S. and China. I mean, ostensibly, this has been a gradually increasing risk for some time. They're competing diplomatically, militarily, economically, in the tech space. I would say that over the last little while, what was probably a more gradual increase in terms of competition as China rose and became more of a direct rival has really jumped to the forefront with the invasion of Ukraine last year. So for the first time in I'd say a very long time, war entered the minds of policymakers, business leaders, etc. And I think the natural thought for many business leaders was, okay, if this can happen in Ukraine, what's next? And so I think that entered the conversation of Taiwan. And it was interesting, I was looking at the Oxford Economics, their global survey a few weeks ago came out, and 87% of respondents said that they thought the probability of China invading Taiwan over the next 5 years was likely, so their base case. In-house, our own view is different. We think we're really talking about a long term before China was to pursue that. But ostensibly, that would be the kind of event that would lead to a decoupling. That would probably drive the US and China towards really kind of conflict, but also increasingly fracturing. There's often an analogy that's used when we talk about geopolitical risk. They call it the Thucydides trap, where an emerging power is kind of take out the existing power, and so the current power tries to cap their ascendance. I don't think the analogy is perfect in the case of China. I'll tell you why. But I would say that geopolitical risk has definitely risen to the forefront, not just for companies, for really everyone across the world. But we're not destined for, I would say, competition. Yes, there are a number of trends heading in that direction, and it feels that way. I'm sure if you read the news and you see the headlines, competition, I think, will only grow, and I think that the uncertainty that affords businesses is significant. But one of my, I guess, where I put my hat on and I say the economic costs of a fracturing of a significant war is enormous. I mean, just having redundant supply chains in a fully bipolar world, we're looking at 5% of global GDP minimum, just like right off the bat. So I know China came out the other day and said 5% estimate growth for this year. They're slowing. They're not growing at 8%. They're not growing at 10%. They're growing at 5%. Probably long-term, our idea is even less than that. So they need a global trading system that operates. It may not be the same. There may be more regional trade than global trade, but I think at the end of the day, where the future growth is for both the West and for China is in emerging markets. There will be competition there, but I don't envision a zero-sum game, and I don't think we are destined for global conflict, but yeah, I'll leave it there.
Okay. So maybe switching gears a little bit, Paul. The 2023 EY Mining Risk Report has seen geopolitical risk continue to rise through the ranks for mining organisations. Where do you see it for 2023, and where do you think the future is going to take us?
Yeah, look, it was the fastest rising risk. So we run a survey to do the report, and it got the biggest increase in votes. It was clearly on people's minds. I think that was because of three issues that we won't see go away. So I think we'll continue to see it rise in terms of the way it impacts people. I think when you look at how those risks impact mining companies, you've got to look at them individually, but then also together, because they do play together in terms of what they do to our mindset and the way we think, but also how they impact demand for commodities. So thankfully I'm not in the 87% either, so I don't think there'll be war, but people are thinking that way. So if you sort of start individually, but you can sort of see the themes emerging in terms of how they work together. So invasion of Ukraine meant for a lot of us, as shocking as it was, meant for a lot of us acceleration in terms of energy transition. Initially that meant we suddenly realised that we still do need coal for a little bit longer. We've seen high-grade thermal coal at record prices, but we've also seen sustained increases in infrastructure materials, so particularly iron ore. The forecast was that iron ore dropped back to $55 a tonne this year. We've stayed well above 100, and our view is that'll continue and we'll stay above 90 for the next 18 months to 2 years in terms of what we're seeing. As that requirement to build renewable infrastructure continues, hopefully we'll see a fair price for copper, so we'll see that increase as well. And we've already seen storage in terms of what's there. So I think that acceleration of energy transition was there. We've also seen a big increase in spending in rearmament as the W word has come into thinking with people, and so massive increases in spending on rearmament again tends to mean iron ore and metallurgical coal. That will continue. Those things don't stop. So accelerate energy transition. China's reaction, the way China thinks, has then made, we've got this accelerated energy transition, but then people starting to get worried about China's influence on a lot of those commodities, and particularly secondary processing. You look at secondary processing, particularly in battery minerals and rare earths, and they're dominant. They're over 90%. So we've seen reactions of nationalism. We've got to do it ourselves. We can't leave it to China. We've got to do things. And so that's impacted us to think again. And while China's shutting off supply from certain countries and embargoes on Russia have initially been seen as difficulty, actually trade flows have worked themselves out. You sort of look at it. The nickel from Sudbury that was going to China has meant that those producers have had to sign better long-term deals with US manufacturers of batteries. In the long term, I think those trade flows are much more sustainable and much better for those. We've seen the same in Australia. Our trade flows have moved to where we're supplying India, we're supplying Japan, we're supplying Korea. Much better in terms of what we've done. So we've seen that reaction. And then the third one has been the swing to the left in the Americas, and particularly Southern America. I think is the other big geopolitical issue we've seen. And that's again exacerbated this move to nationalism. Responses, was IRA because of China or was it because of what's happening in South America? It's a bit of both, in terms of what's there. And so you're seeing this swing to, we've got to do it ourselves. So countries have started to think more inwardly. And as mining companies, we've had to think about that as well. And that's accelerated some of the big transitions that are happening in terms of what we produce and where we play on the value chain. And those sort of things have been big changes as well in terms of what we've been doing. Might pause there and let others continue.
So it seems like China's a hot topic, and it doesn't, and I don't think it, irrespective of the industry you work in, it's going to be something that everyone needs to talk about, but particularly here. So David, shifting across to you and looking at the financing side of the business, obviously with China being such a hot topic, what is government doing to neutralise China's stranglehold on metal and processing, and how is that affecting investment financing?
Well, I think the key thing is panic. Most governments and blocks of governments are in complete panic at the moment. The US have got $1 trillion infrastructure, bill that's passed. That's everything, ports, solar, and then they've just announced their Defence Production Act, which is a bill to get all the processing that's in China in the US. And that's going to be trillions of dollars to be able to manufacture and change that processing. So the US have seen the signs, and I disagree. I disagree about Taiwan. We all said not going to invade Ukraine, didn't we? Russia's never going to invade Ukraine. Anyone predicted that 2 years ago? And now we're saying they're not going to go in Taiwan. I think we're a little bit naive here. And I think the politicians are really scared. And you look at the US with $1 trillion moving all the processing. I think Nevada Lithium, their permit got approved. Biden and legislature said, look, we're just approving this lithium mine. We've got to get lithium, in production in the US to supply the battery, et cetera, et cetera. So I think from our perspective, the countries and the EU have got a big debate between themselves. It'll take months, of course, because there's too many of them. But they've got a big debate about how much their budget is going to be for processing in Europe. And you're seeing that as in Indaba, and the African nations are talking about how they can keep production and processing within Africa rather than having to go to China, where most of it goes, and Australia, most of it's to China as well. But we've got to change. Excuse me. And I think governments are scared about it, and they're now focusing on keeping minerals within their region. And they've got to be friendly countries within their region. And if you go to the US now and you talk to processing manufacturers, you talk about where you want to put your processing plant, the US. $1 billion every day is going to be spent on increasing processing facilities. So, from our perspective, where's the money going to come from? Governments. And the US is leading the way, Europe's trying to catch up, and other countries and other continents are trying to catch up as well. So governments are going to fund the big boom cycle, taking away from China. And how's China going to react? That's my concern. And the other concern is China owns most of the US debt. So I wouldn't upset China if I was the US, because then your debt is just sold one day and you're bankrupt. So the politics and the economics is mind-blowing, in my view.
Interesting. And looking at that and the impact to companies, David, how are companies, and especially at the board level, looking to circumvent some of those trade tensions that are there? And obviously, the geopolitical uncertainty, you've got two panelists that are disagreeing as well.
Well, yeah, that's right. And I think there'll always be some disagreement and some good debate, which is always a healthy thing. But David was talking about having to build facilities in the US and in the EU to treat the minerals. I look at it far more from where the mineral's coming from, where you're digging it out the ground. And that's not always in Nevada, in the case of Nevada Lithium or whatever. They're coming from all over the world. And I operate on 2 continents and in 5 jurisdictions, and each one has its own little challenges, and you know, we need to get the ore out of the ground. So how do we make sure that we can do that? And that's by engaging with our local stakeholders. It's the national government in each jurisdiction, it's the local government, it's the local stakeholders. And we have to make sure that we have great advocates for our business in each one of those stakeholder pools, if you like, to make sure that we can continue to operate there, produce the minerals which can then go to the nice facilities in the US and the EU, if that's where it's going to go. But that's the biggest and most important task that we have, is to build that advocacy group, be it with the governments or with even local suppliers, with local trade associations. We have to, as an industry, we're incredibly poor at building advocacy groups to support our business. So that's a fundamental step that we need to take and reinforce.
And it's a good pivot, because ultimately you can decide on where you're going to process, but you can't decide where the deposits are. So building on that and the engagement with local stakeholders, Paul, like if you're looking at some of the strategies that companies are looking to implement with respect to engagement of local stakeholders, how are companies looking to do that around license to operate issues?
Yeah, look, I think just despite the headlines, I think most companies are doing a good job. The problem is license to operate gets to brand, and it's broader than what people typically think of it as. So I think when people hear license to operate, they typically think local community, Indigenous community. What do we do? What does that look like? And I think we've generally done better in that space, and you particularly look at some of the investments that have gone into water, some of the investments that have gone into health, and those sort of things have been fantastic. You go into any region of Africa, and Anglo-American and their sort of vaccination campaign is the word you hear. But we continue to stuff up. We continue to do things that we say, yes, we're committed to value, and yes, we're committed to the long term. And then we make a snap decision around something and we do the wrong thing, thinking that we've got license. And so I think continually communicating, continually being aware of what's there, and realising that if you're dealing with local, things can change very quickly, is the strategy you've got to employ. So I think that's really important. But I think the broader issue on licence to operate, and it goes to the comment about capital coming from governments and significant amounts of capital coming from governments, is we do have to have an industry effort to lift that brand and lift what we're doing, and those companies that can be seen to make a positive contribution on a broad range of factors are going to be the ones that succeed from a licence to operate perspective. So getting that right to be able to help a government develop their natural resources, process within country, get access to the infrastructure dollars that will give you the energy required to do that processing and changing of the materials, is really going to be critical to the success. And I think one of the barriers to getting to being positive in community is our obsession with net zero at the moment. Net zero does not give you positive. It gives you zero. It just keeps your status with that society, with governments, as it is today. And I think the big advice that we give to companies is you actually have to be net positive. So you've got to think through what are the elements within our value chain, within our business, that we can be positive on and do those. So is it paying a fair share of taxes where we have to, rather than thinking through the way we've got to avoid them? Is it providing excess water, like Anglo-Americans done in Peru with Quellavecchio, to be able to provide communities with what they need, with seemingly little advantage to the site? But when you step back and look at it, you look at MMG that's had 500 days lost due to community action, and Quellavecchio, which has had 0 days lost production. That's value to me in terms of the way you think about it. So the big advice we're giving to people around licence to operate is stop thinking net zero. It'll give you nothing by the time we get to 2050. to stop it and go to net positive. But net positive in the things that make sense for your strategy and sense in the areas that you operate in is where we're sort of pushing people to go.
Interesting concept of net positive. And looking at that example associated with zero compared to 500 days shutdown, looking at Fortuna specifically and looking at license to operate issues, how is Fortuna handling these issues, and what are some of the lessons learned that you can potentially provide to other organisations how to tackle this issue?
I think the backbone of it all is building on, what you said, is communication and engaging with the stakeholders. I think as an industry, we've always been very poor about communicating what we actually do for the communities, for the stakeholders, and making sure everybody understands. And we're always too quick to go to government and complain and say, well, we need help with this. We need to turn that around and say, and communicate regularly with our local governments and regional governments. This is what we're doing, and this is what we're bringing to you. And we're not here to ask for something today. We're here to tell you that we've paid 50% of the profits in tax. We're paying our royalties. We're paying payroll taxes. We've employed X number of people. We've got the trickle-down effects. We've got lots of indirect labour creation and that sort of thing, and send that positive message so that the decision makers in any jurisdiction understand what the contribution of a mining enterprise is in that jurisdiction, because most of the time they have no idea. I've had huge success with just presenting a couple of pages of statistics. This is how much tax, this is how many people we employ, this is what we're doing, and this is what we're bringing to the party. And that builds huge goodwill. So they understand that they're actually getting something out of it, and it's not all take, because the perception is that the mining companies are just taking, when we're not, we're actually giving back. And if you look at the tax burden of mining companies in the local jurisdictions, not at head office, not in Toronto or Vancouver or London or whatever, the tax is paid locally, and they need to be aware that that contribution is going into the coffers of that particular jurisdiction. So that's absolutely the bottom line for me, is where we really need to always focus.
Excellent. And if you're looking at a broader risk management strategy associated with geopolitical risk, it would be remiss of us, obviously, to not talk about risk transfer solutions as well. So Chantal, what are some of the market trends associated with, given what's been talked about with respect to Russia and Ukraine, given the prospect of continued geopolitical uncertainty in China and Taiwan, how's the insurance market responding to this? And how are organisations looking at this from a risk transfer solution?
Yeah. So first of all, let me just say that I do really believe that risk transfer solutions are only one part of the sort of a comprehensive risk strategy solutions for mining companies. You've mentioned advocacy with local stakeholders, a strong social license. Those are really important components of a comprehensive risk mitigation strategy for sure, and there are other elements as well. But in terms of risk transfer, political risk insurance solutions, which really are intended to cover emerging market exposures, right? Exposures in politically, economically sensitive jurisdictions, ensuring exposures such as physical assets, cash flows from contracts and investments, debt and equity capital investments. These are really important solutions as well to address this risk, and they're still being deployed. There's an increase in demand for political risk insurance just against this backdrop. That said, the market is definitely hardening. We've seen that with a severe curtailment in sort of capacity, which is really driving higher premium rates. We've seen certain structures actually being completely set aside by some significant insurers in the market, namely sort of multi-country political risk insurance programs, especially where there's Chinese exposure on the program. And that is true for long-dated sort of renewals, long renewal customers. So we're seeing prices increase in the low double-digit space on these renewals and on new business placed. So in this environment, underwriters are really going to their comfort zones, as you might imagine. They're not really looking at opportunistic inquiries. They're focusing on sort of select corporates, and underwriting is really focused on, underwriting the insured, underwriting their track record in market, underwriting their experience in the country. But maybe one last point on market. It's a very deep market. The political risk insurance market is comprised of about 60 underwriters. There's the Lloyd's market, there's the company market, there's commercial and public insurers in the market, the latter being sort of the ECAs. And David, I wonder if ECAs will be stepping up to take a more prominent role in financing, right?
Next question, I think.
Yeah, exactly. So definitely, it's a deep market. So it's resilient and healthy, but the state of the market is definitely capacity is curtailing, and pricing is actually somewhat more difficult than it was a few years ago.
Excellent. And this is just a word of warning. We are going to be coming to you soon, so make sure that you've got your questions ready. So as we pivot a little bit, David, looking at, and one question I'm particularly interested in is the M&A market as well, right? So what are we seeing with mergers and acquisitions, and what do you think is going to happen in 2023? And also, what are the obstacles in front of mining companies looking at potential mergers and acquisitions?
I think the key factor is inflation. So inflation is affecting all the world. Different countries have different inflation rates, so some are doing better than others. But that's driving the cost base for all industries, and obviously mining, fuel, etc., etc. The costs are going up and up. So M&A, I think, is going to be driven by companies looking to buy assets where they can get their all-in sustaining cash costs lower to keep that profitability. We had that, probably 7 years ago as well, when prices were low, prices are reasonable, it's just costs now are squeezing margins. So the M&A business is going to be really focused upon that to try and keep their profitable margins, in my view, on that respect. Are there many companies with low or sustaining cash costs? No. So there's going to be a big fight, I think, for some of these assets.
Excellent. And switching gears as well, Paul, looking at a lot of mining companies in the recent years have come out with new purpose statements, new visions. How is that affecting the industry as a whole, and what sort of outcomes do you think that's generating for a lot of these companies?
Yeah, look, it's been quite interesting. I think they all came out with initial purpose statements, and then some of them have restated, but they've all adjusted their strategies as well, and we've had some big statements around that in terms of what we're doing. Initially, the reaction to that was, we're going to look at portfolio mix. Initially, that meant we're going to get rid of our coal, because we think it's impacting our share price on capital markets. And so you saw, either sell-offs of that, or spin-offs, in the case that, the most recent one with Fungala. That, to me, that's not a strategy. That's just your portfolio. And particularly, it wasn't strategy because they all then looked at where else they were going to go. And I haven't seen one of those new portfolio strategies that hasn't had copper in there. And of course, all those assets are overpriced, the commodity is underpriced, and so none of them have proceeded with anything because they can't do anything about it in terms of what they're looking at. So they've sat back again last year and they've re-looked at the strategies again. And that sort of caused a really interesting change in perspective. So what they've basically said is, we're going to extend along the value chain, and we're going to transition from being minerals companies to being materials companies. And you've either seen this quietly, with a lot of the nickel producers moving down the battery value chain, particularly with the grade 2 stuff. You've seen it loudly with some of the iron ore producers saying we're no longer going to ship iron ore, we're going to ship iron. Whether that's direct reduce, whether that's Twiggy using hydrogen to sort of do things, whatever it is, they're all sort of looking at those things. You never see a lithium project go up unless it's got a chemical plant attached to it and it's lithium hydroxide in terms of what's there. And so that move down the value chain has been really interesting in terms of changing the nature of mining companies. You're going to a completely different risk class of asset in terms of what's there. They're going to have to convince capital markets to accept that move, accept the way that they're placing their bets, and look at them differently in terms of the way they assess them as businesses. I think more sustainable businesses, so I think in the long term it'll be really positive for them. but the capital markets needs to be convinced in terms of what's there. Once you break that sort of nexus of just being, minerals producers, and you move down the value chain and you do something else, it starts to then open up the opportunities to do other things and break the value chain in other places. And so we've started to see that break around horizontal integration. So they're sort of sitting there and they're saying, how do we meet our net zero commitments? What does that look like? We've got to take more responsibility for it yourself. So we've started to see mining companies reinvesting in power generation. So, a lot of advisors in the room would have made a fortune in the 80s selling power stations for mining companies to power and utility companies. We're going to see that swing back in terms of what's there. So particularly the tier one companies are going to produce their own power. Mining companies are terrible at doing subscale things. They've got to do things at scale. We're hopeless at running small things. So they'll do it at scale. They'll provide energy for other things. If you can provide energy, why don't you provide other things as well? So why would we buy carbon credits when we can produce our own carbon credits? Starting to look at how they invest in renewables in that way, not just renewable energy. And we'll see them start to invest in technology. So I think the next 2 or 3 years is going to be really interesting because we're going to see that traditional model of just being businesses. We haven't even explored for 20 years. We've just been producers, particularly at the big end of the market. We're going to see that break. We're going to produce things. We're going to generate power. We're going to generate solutions. We're going to totally change the nature of a mining company. So we think that change is starting now. We're going to see this big transition. That is real transformation of the way that businesses are operating. We think that's going to happen in the next couple of years.
Excellent. And looking further down the line as well, when we do that, there's obviously impact associated with what you've talked about with social unrest and social licensing. So Chantal, there's been an increase in geopolitical events, specifically in Latin America over the last 12 months, specifically around social unrest. So what are some of the events that you've seen that have affected some organisations, and how have they impacted the mining companies themselves, and what are some of the lessons learned?
Sure. So the social unrest is definitely on the rise globally, but it seems that Latin American countries are going to the streets more violently, in a quicker fashion. There's no shortage of examples of social unrest in Latin America. The two most recent ones that come to mind, or one recent one that comes to mind, are these sort of recent blockades and protests in the Andean in Peru, affecting Las Bambas and I'm going to mispronounce this, but Antapaque mine. And those protests and those blockades have prevented important supplies from being delivered into the mine and from having copper concentrate being shipped out, right? So impact of that is, if those types of activities are sustained, there's definitely a negative impact on profitability. And again, protracted, it can certainly sort of put into question continuity of operations. Certainly, when lenders are not being paid because product is not going out to market, or when shareholders are sort of seeing a negative impact on share value because of those types of events, it's definitely not good for a miner. Maybe just not so much in terms of social unrest, but in terms of providing examples of illegal government actions that have impacted mining companies in Latin America. I'm thinking, of course, the one significant event that everyone has certainly thought about over the last year and a half is the nationalization of lithium in Mexico by AMLO. It would have been unthinkable a few years ago to think of Mexico, USMCA market, breaching an international agreement with northern neighbors, but it in fact has happened, and it's really leaving sort of holders of lithium concessions in quite a bit of uncertainty, because it's not clear that the government of Mexico is going to compensate those mining concession holders for any taking of property rights, right? The government has said we will continue to allow foreigners to be involved in the sector, but we want to control those investments in a majority fashion going forward. So it's really not clear what happens to those concession holders going forward, right? So that's a really prominent example of the type of illegal action that's impacting investment in Latin America.
Excellent. And looking at that and coupling that risk, when staying in Latin America, a lot of central banks, to the point that David made, everyone's trying to tackle inflation. The central banks in Latin America, and particularly those jurisdictions that are big jurisdictions for mining companies, are doing the same thing. So how is that impacting mining operations in those specific countries? And what do you foresee the future is in those inflation tackling events that the central governments are implementing?
Sure. Banks are operating differently. You've got Brazilians who are more hawkish. You've got other central banks, Chile, Peru, others that have been slower to raise rates. There is definitely a dampening effect on growth. We're seeing it. It's also affecting consumption in those local markets. And if you think about the impact on their currencies as compared to the U.S. dollar, they've generally been depreciating. This is not just a comment on the actions of those central banks. There are country risk-specific issues that are driving some of these events, like Chantal was mentioning. Peru, for example, that are bringing down their currencies. They're affecting yields in those markets. So I think on net, the impact is dampening for growth, weakening some of the currencies, and therefore carrying over into inflation, because to import is becoming more expensive. So I would say that's probably on the growth side the first thing. In terms of, I guess the second question was more about kind of the outlook for the region and specific markets. To me, this is not the pink tide of the early 2000s. So kind of going off where Chantal was talking in terms of government interference, governments don't have the same fiscal space that they had in the early 2000s in the commodity super cycle. So that, to me, limits their ability to pursue some of these more radical policies. We've seen a slew of more left-wing governments, for sure, in the last couple of years. I think that speaks more to populations just being tired of the current governments and wanting to replace them, as opposed to specific ideological pursuits. So I think the market will also constrain their ability to pursue some of these more radical policies, plus how they were elected. So that's kind of at the macro level. I think within certain countries, there's also the constraint there about minority governments. So some of these leaders came into power, their ability to pursue more radical policies vis-a-vis the business environment are significantly constrained. So take Peru, for example. Obviously there are kind of these short-term impacts that we're seeing now in terms of blockades and protests that are impacting the business environment. But because you have such a weak government in place that can't even agree upon when the next elections should take place, that means that it's going to be very unlikely they're going to pursue more radical policies vis-a-vis changing the business environment or mining. And I think the same thing to a lesser extent is true in countries like Colombia, or even Brazil for that matter, where your ability to pass legislation, significant legislation, requires more coalition governments, and so I think that will act as a constraint on some of those more radical policies. Of course, AMLO is a separate case. He's his own, does his own thing, and I think it is kind of surprising that AMLO, that we have a government in Mexico who is like that. I think typically Mexico's been more, you've seen more government interference more in the energy space than it comes in the mining. I think that's a bit different. And I think that the mining sectors tend to be more about the social unrest issues in Mexico as opposed to government-specific legislation. So I guess when I look at the region in general, I definitely see there are pockets like Chile where we will see changes in the regulatory environment. but even in some of those countries, populations are still relatively conservative and are not looking for governments to make radical changes as it relates to kind of killing the golden goose, if you will. And I think that governments are aware of that, even if the rhetoric is different. So I think economically we'll see a number of countries continue to underperform, like in the case of Mexico or in the case of Brazil, where they should be. And I think the number one word that we're looking at, or the number one kind of issue that we're looking at in Latin America, is policy uncertainty. So I think that goes without saying that we're still in this period of new governments feeling their ways out. But I think there's enough constraints there, both in the market, their own fiscal space, and kind of popular sentiment, that I don't see radical changes across the board, kind of some changes on market by market basis.
And touching on the point that you mentioned, Ian, and Chantal, about resource nationalism, and David, coming to you, obviously this has been something that's affected mining companies for a while. What do you see with respect to the future associated with resource nationalism, both in 2023 and beyond, and how are you looking at that from a company point of view?
Well, I think our expectation is to see certain moves by governments. They want more money, so it's going to be increases in taxation, be it in corporate income tax, be it in royalties. It's going to come from that side because they want more cash flow. At the other end of the spectrum, you've got the expropriation threat, which Mexico is a recent example. But I think that's going to be on the rarer side of things, because expropriation, if politicians look in their history books, they'll see that it's not usually been a very successful enterprise. It doesn't bring a whole lot of money to the government in short order. Maybe in the long term it can do. There have been some notable exceptions. Codelco's one. Zambica's Coal Mines was not. So there's a whole gamut there. But I think that's a dangerous game it's a slow game for the governments to play. They want quick cash, so it's going to be money grabs in terms of tariffs, royalties, taxes, and the only way to counter that is to going back to what I was saying earlier, is to building your lobby groups in country and point out that if you overtax, then you kill the goose that lays the golden egg, and illustrate the fact that there is already a considerable amount of tax revenue flowing into the local economies, both in terms of straight contributions to the government coffers and indirectly through employment and indirect employment. That's really our strongest defence.
Excellent. And looking at that, you mentioned governments looking to capital raise, shifting gears in terms of financing, and looking at the impacts of inflation. Cost of capital is increasing significantly. Potential recessions are on the doorstep as well. So how are mining companies looking at this? How are the financiers looking at this? And particularly for junior miners, how is the aspect of raising capital affecting them at this point in time? What do you see now?
Yeah, it's certainly getting tougher. There are less banks, commercial banks. BNP have just moved out of mining, so there's one major player out of the market. But I think for the junior sector, it's always been, driven really by, and you mentioned the really export development agencies, the credit support from governments. So if you're, and I'm working with EDC at the moment, and they are stepping up to fund Canadian junior mining companies. So you're seeing governments saying to their own agencies, look, please, develop. We need to develop our mines. We need to develop our, businesses. So COVID was another key factor. Coming out of COVID, the government said to all their export credit agencies, all their funding sources, get out there and sell our products. So Germany did a big campaign going around. A lot of the financiers, a lot of the people like ourselves in the middle, arranging these finances, say, look, we want you to buy German equipment. So if you're going to finance a mine, buy German equipment, and we'll provide government support. So we saw that, and that was the boost, really, trying to give the countries a boost with COVID. Now we have the same thing happening now, with the fact that we need the source of materials. So we're seeing the same thing. So really the government's export agencies. And critical minerals, metals, you mentioned that word, lots of government support for that. Gold, obviously. Fortunately, the capex for most gold mines is lower. You don't get as much government support. So if you mention critical metals, copper, whatever, EV story, then huge amount of support from government. Obviously, in the gold sector, it's more difficult. And really, the gold sector, I'd say, the private credit funds and the streamers are taking over on the gold side. So you're getting more private credit providers on that side, more government providers for critical metals.
Okay, and staying on mining financing, and just quickly, Chantal, obviously the project cost of capital is, you can look at it, and the way to mitigate some of that is through political risk insurance and obviously and transferring that. So how can you utilise that vehicle to impact the project cost of capital?
Sure. So historically, actually, political risk insurance has never been considered a component of sort of any finance decision. It's not been taken into consideration by lenders or investors in the capital budgeting process. And that's just because that intuitively investors understand the qualitative benefits of political risk insurance. They just have not quantified sort of those same benefits. And so that way of looking at political risk insurance has really been challenged recently, and really as a result of a recent study that was commissioned, a study performed by Standard & Poor's, commissioned by Marsh. And the findings are as follows, right? We know that sort of investors in risky investments in emerging markets need to be compensated for taking country risk. That translates into ensuring that a country risk premium is added to an investment's hurdle rate, a required rate of return. So with the, and of course we know when we increase sort of the hurdle rate, we actually we reduce a project's value, asset value, right? With this new finding, or with this new sort of S&P country risk investment model, what we're able to do is quantify actually all the political risk related losses and translate that into a country risk premium. And so and then the S&P work was able to sort of also match up actually those same quantifiable political risk losses to those actually that can be mitigated by political risk policy. So by doing that, what we're able to do is actually, by identifying a political risk insurance policy attached to a project rather, we're able to justify a reduced cost in capital. We're able then to actually argue that improves asset value, that improves internal rate of return. So, you know, historically, while we've not considered PRI at all in the investment mining finance decision, now with this study, we're saying actually utilizing political risk insurance improves cost of capital, improves asset value. It's actually accretive to asset value as opposed to being a cost that negatively affects the investment. So that actually allows investors to finance or mobilize financing on improved financing terms.
Excellent. So with that, I'm going to open it up to the audience with respect to any questions that anybody has whilst we wait. I did warn you. Lexi.
Yeah, I thought that the comments regarding net positive were really interesting, and specifically, can you comment further on mining companies producing their own energy, and specifically investing in renewables and technology, and the perspective that simply being producers is changing. My question is, what can be done by the mining ecosystem, advisors, financiers, others, to support this transformation? What are first movers doing, and what are the opportunities here?
Yeah, look, so I think as we struggle to find economic projects to develop and do those sort of things, and as the nature of what a mine looks like changes, a mine's not going to be, in 30 years' time, the big mines we talk about aren't going to be like Bingham Canyon. They're not going to be one single continuous big hole in the ground. They're going to be lots of little, operations spread around over a geography. Things are going to get complex, and so I think this breaking of the value chain is going to be more. I think the opportunity for others probably starts with capital. as always with any mining endeavour, it's what we put at risk, and it tends to be the big uncertainty in any project. So I think that probably comes first in terms of consideration is thinking differently about capital and thinking differently about how you spread the risk and you expect a return in terms of the capital that you're investing in those projects. I think that will mean that capital will come from a bunch of different sources. So we've talked today about government and a little bit about private equity for the gold sector, but I think equipment suppliers getting back into providing capital is going to be a big source. So whether that's OEMs or whether that's others, I think we're going to see the return of entities like the Japanese trading companies coming roaring back into fashion. So like they did in the big developments in the late 60s and early 70s to guarantee a source of supply for Japan as it sort of hit the next phase of redevelopment post the war. We're going to see them investing what they can in terms of energy transition and being part of that. And then the other source, of course, is customers. And we've already seen big announcements by a lot of the auto manufacturers about what they're going to invest in capital. We've started to see it in terms of technology companies. We've seen Apple talk about it. We've obviously seen Tesla talk about it, whether you call it a technology or an auto, there's sort of a bit in between. But I think that customers providing capital is going to be a big one as well in terms of what's there. I think too, being part of the message and helping companies lift the brand is probably going to be the other big thing. The brand is what will hold us back. Where everyone in this room, you've got to assume, is really positive about the mining industry and positive about where we're going and positive what we do. Some of you, like me, will not live in a mining town anymore, and that attitude is not general in terms of what's there. So how do we lift that brand? How do we make sure that we continue to get a positive reaction from people around the globe? How do we get people to realise that minerals are the critical part of the energy transition, that without them it's just not going to happen? How do we continue to attract the best and brightest to the industry? Kids don't want to go and work for mining companies anymore. How do we do that? So I think, getting universities to realise that, continuing to develop, will all be critical as we move on. So I think, the ecosystem plays a critical role, both in terms of providing capital, but also helping to lift the brand, would be my perspective.
Thank you.
Any other questions? I think we've got time for one or two more. Anton.
Thank you. Thank you to all the panelists, quite insightful today. I'm just curious to ask about one word that Mike mentioned, recession. Just to get each of your perspectives on, where the possibility of recession may play itself out. Would it be more localized? Will it be on a grander scale? And how long potentially could a recession last? Thank you.
Start with you, David.
Well, that's... where's my crystal ball?
Everyone's got their pens at the ready.
Yeah. The oracle is about to speak. Sure. Recession. I'm in absolutely two minds about that. I see the increasing demand for metals, the transition to the new energy paradigm, and that doesn't speak recession to me, because people will be active and doing things, and there'll be jobs, and they'll be paying taxes and stuff, which kind of anathema to recession. On the other hand, the central bankers are all telling us, they're raising the interest rates, and they're scared that the recession is coming on that basis. And on the other hand, you've got, this is the third hand, of course, you've got companies screaming to employ people, which is, that doesn't happen in recessions as far as the way I was raised, but that was a long time ago. So, do I think that there's a recession coming? Probably not, actually, on balance, but that's my little humble crystal ball. I'll hand it over to these more economic-minded individuals than me. I'm just a guy who digs stuff out the ground. So.
Ian?
Actually, we're doing our forecasting later today and tomorrow for Q1, so I can let you know the numbers after.
The ultimate hedger.
No, I think if I was to compare, even last quarter to where we are now, I think we were a bit more concerned last quarter about a recession. It's probably come down a little bit. Europe's done better. They've had a balmy winter, so they've avoided some of those really higher energy costs, driving particularly German economy down. So that's a bit brighter. I think the U.S. has been more resilient than many envisioned, although we're still likely to see additional rate hikes because the job market is still quite strong. I guess we'll see numbers out this week for the labor market. Canada might have, a mild recession, but I think what I would say is that probably our concern has grown more from the developed markets to emerging markets. I think emerging market risk has gone up, particularly sovereigns. So we're no longer in our shop worried about the Sri Lankas of the world. It's more starting to move up into the Egypts and the larger kind of emerging market economies. So I think that's probably the higher risk in terms of a recession emanating from there as opposed to developed markets.
Yeah, the only way to beat inflation is to have a recession. You've got to cut off demand. You've got to cut off consumer buying. You've got to kill the economy. So we're going to have a recession. Otherwise, inflation will take hold and we're going to have a recession.
Paul?
Yeah, I'm in Toronto in March rather than on the private island I own in the Bahamas, so my crystal ball's not that good. But I agree with David. We're going to a recession. We have to have. You've got to stop demand in consumers. I think we'll do well out of it as an industry.
I agree with that. David's point about the amount of money going to buy metals for the transitional side of life. So we're going to be fine, but everybody else.
Yeah. No, I think
you can get your island now.
Absolutely. Yeah. No, you still got to sell time. But yeah, I think we're going to have a short, sharp recession. We've got to give a kick up the bum to a few people, but our costs will go up and our capital will be more expensive. So we'll unfortunately delay a few projects, but I think we'll roar out of it. So that's again forecasting. That's why I think times look good for 3 to 5 years rather than saying good for 1 to 2 years, because we'll be okay during this, and then post-recessions we always do really well. You look at ones in the past, mining's always done well, so we'll do well during this one, we'll do well post. You've got to think times look good for 5 years. Again, I'm in Toronto in March.
I'm going to be provocative and say that I'm pro soft landing. I don't think actually we have a demand issue. I think we have a supply issue. So, and I think China coming back to sort of the global economy is and the unwinding of supply chains is going to help us sort of circumvent a recession and therefore sort of get to a soft landing. So, there.
Excellent. So we're at time. I just wanted to allow each of the panelists, firstly, thank you for attending. But one final thought to leave the audience with before we depart today. David?
Well, we're talking about resilience. It was in part of the conversation, and something that we think about as a producer, as a company operating on the ground. We think about how do we make things more resilient, and I've talked about the engagement and with people. The other one is with your suppliers. I mean, we depend on suppliers. We need steel, we need energy, we need reagents, we need all those things, spare parts. So what do we do to help build that resilience in? Because, we were building a project and we needed a particular part from Ukraine. And we finally got it, but it wasn't easy. It was a very small part, but it was needed. So how do you build in resilience? So we put some thought into that, and you're looking at maybe having not just one supplier, but now you have several suppliers. You split up your contracts. You increase the stocks of your materials on site and stuff, but it all adds money. You need more working capital. You increase the cost because you're buying smaller lots, but more of them. But it's something that we think about. It's something that we need to address to make sure that we don't run out. I mean, I've been in situations where there's been a truckers' strike or whatever, and the fuel supply doesn't arrive at the mine site, and you realize that, well, having 3 days supply of fuel is not sufficient. We want to have actually 3 weeks. So that's the kind of nitty-gritty practical action. It's not the big thoughts, guys, but it's the nitty-gritty things that we need to do on the ground to ensure that we can keep the cash flow from our operations, and that's what we're all about. As a company, we need to preserve our cash flow.
Excellent. Ian?
Probably say uncertainty. I mean, I don't think there is no returning back to what I call new normal or things like that. I think we are looking at a more complex world. That's a fact. But it is worth considering. We started by talking about geopolitical risk and that it's on the rise. I think it's worth thinking about that geopolitical risk ebbs and flows. And so I think that we're at a more isolationist moment in history. You know, we could have said this a few years ago with the rise of Donald Trump's and Brexit and things like that. COVID didn't help that. It turned all of us inwards, including governments. And so we are seeing more protectionist policies coming up today by America First type of mindsets. And I don't think that is destined to stay. I think we're kind of in that moment right now, but I think will kind of reopen towards, again, maybe a trade will look a bit different, more regional trade, take into account ESG concerns, but I think, yeah, baking in a fair bit of uncertainty to your long-term plans.
Excellent. David?
Yeah, I think we're coming to what is going to be fairly positive for the mining industry, purely when you see these governments looking to, bring processing in country, develop mines for their own resources, really, and obviously the US defence industry is massive, and they're really driving to get everything within their control so they can continue with their defence strategies and continue with what they're doing. So I think we've got a good couple of years ahead of us, and the governments are going to provide that funding. So we joked about recession, and I'm glad some people think it's going to be soft, which is great. I think we're in a period where there's going to be, I think the mining industry is going to be faring very well. Consumer businesses, not so much. So I think I'm very positive.
Paul?
Yeah, I think I'd just reiterate that. I think the industry is in a really positive time. We not the best commodity prices we've had in the last 20, but really good. If you can't make money at these rates, you're not doing it. Think about how you invest that for long-term value. I think is probably the message we'd sort of like to leave is, they're not our minerals. Yes, we've spent capital. Yes, we've won the right to development, but the minerals aren't ours, and we need to sort of work out what's a fair and equitable way to share those. I think if we keep that in mind and we're broad in terms of the way we go about it, we'll be able to continue to be successful for longer. I look forward to being part of that. Thank you.
Chantal?
Yeah, I also think the future for miners is positive, but sort of as the Marsh risk person on the panel, I think my takeaway here and my sort of final thought is that miners should definitely make sure to have a comprehensive risk management strategy in place, not the least of which is an insurance risk transfer solution, but things like making sure they have good local engagement with stakeholders, sound contracts that and fair and equitable contracts with a good sharing of benefits with local communities. So just a really good sort of sound, comprehensive risk strategy to deal with uncontrollable sort of political events that are unforeseeable. So that's my takeaway.
Excellent. So David, Ian, David, Paul, Chantal, thank you. A round of applause for each of the panelists. And thanks to each of you for joining us this morning. We thoroughly hope you enjoyed the event. If there is feedback with respect to items that you would like us to put on for next year's conference, please let us know. But otherwise, enjoy your day. For those that don't know, we do have a reception at 4:30 at Kelly's Landing, so please, by all means, you're more than welcome to attend that, where there is a raffle, if I am, about a flawless diamond that will be going to support the Canadian Cancer Association. So please attend that, but thank you for attending, and we hope you enjoyed the session.